Alrighty. So in today's video, I'm going to be sharing with you the 7-step Iron Condor trading plan. So this is a complete trading plan that gives you the entry all the way to the exit. So if you are new to trading Iron Condors, right, you have never traded Iron Condors before and you're interested, just to try it out, or maybe you've been trading Iron Condors for a while and you want something much more concrete, then you can definitely use this trading plan. Now, this is a very simple trading plan. It is not the only way that you can construct the way to trade Iron Condors, but it's definitely a good way to get started, right? A good way to get your feet wet into trading Iron Condors. Okay, so without further ado, let's get into these 7 steps. Now, the very first step is to build your watch list, right? So your watch list would normally consist of index ETFs and individual stocks. Now, when it comes to trading Iron Condors, my preferred approach would be to trade the index ETFs. So if you were to take a look down here, this is a graph down here that shows, the movements between the ETFs and the stocks. So as you can see down here, ETFs is this color, light blue, whereas the stocks is more towards the orangey yellow color, right? So as you can see down here, what this graph is really showing you is that the range down here of the ETFs is usually much more concentrated, more tighter towards the center part, whereas the stocks wise, right, as you can see, their range is much bigger, right? So when we are trading Iron Condors, what you need to understand is that this is a strategy that seeks to profit when the market stays within a certain range, right? Because we have a call spread at the top and we have a put spread at the bottom. So let me just draw out this Iron Condor structure down here. So as you can see down here, this is the Iron Condor structure. You have the put spread at the bottom and you have the call spread at the top. So as the market comes down here, what it's trying to aim to profit is from this range down here in the middle, right? This is where we're going to make the profits. So when you're trading Iron Condors, we generally want an underlying that stays in a very narrow range most of the time, right? So if you were to compare index ETFs and individual stocks, index ETFs would actually be the better underlying to trade, a better vehicle to trade, mainly because it's not as volatile as stocks, right? Individual stocks are much more volatile. True, you get much more premium, but that's also because there's much more risk, so to speak, in terms of the movement of the underlying stocks, right? Stocks, because it's just a single stock, one big news, right, can really move the stock in one direction or the other, and that can easily breach, one of the sides of your Iron Condors, right? May breach the wings of your Iron Condors, which is not what we want. Whereas index ETFs, especially the broad-based index ETFs, where they consist of, many different underlyings inside of the index ETFs, the chances of it, making such a big move based on one stock's news is not as huge as compared to the underlying, or rather a single stock. So that is why for Iron Condors, if you want to have a better chance of winning the trade, then you would want to go for the index ETFs. Now, step number 2, once you've already built a watch list of your index ETFs and individual stocks, right, preferably most of them are index ETFs, this is where you want to go through your charts, right, the charts of each of the underlyings that you have on your watch list, and you want to identify the previous highs and lows. So this is what you do. You can go through every single chart and then you take a look at where the price is. So let's say, for example, down here, you can see on the chart, the price is somewhere around here, right? This is where the current price is. So what you want to do is find the previous high and then the previous low, and then you draw these lines across, right? So as you can see down here, these are the lines that kind of depicts the range of where you can build your Iron Condor, right? So if the current market price is inside of the previous highs and lows, this will be the underlying to place an Iron Condor on. And preferably where we want to have our strikes would be outside of this previous low and previous high, right? So again, let me just draw out, this is -1 +1. So this is for the call side. Again, now here, this will be -1 and +1 on the put side. So the main reason why we want to identify these highs and lows is that in the event whereby, the price do actually trade up, or maybe it trades all the way down and it hits one of these previous highs and lows, it actually serves as a kind of a support resistance, right? Where the market could come back up again if it bounces off this support, and it could come back down again, right, if it bounces off this resistance. So making it a likelier chance, a likelihood that the market will stay within your Iron Condor range as you trade it. Now, step number 3, once you've already identified what is the underlying that you want to trade on, The next step would be to identify the DTE you want to use, right? So DTE is basically the expiration dates, and generally we want around the 45 DTE mark to have a long-term statistical edge, right? So as you can see down here, this is the option chain. So as you can see, you are faced with quite a number of expiration dates to choose from. And one of the things is that many people like to go for the shorter term, right? They like to go for maybe 0 DTE, or maybe they like to go for the 7 DTE ones, or maybe some would go for 14 DTE, which is 2 weeks. And the reason why most people want to go for this shorter term trades, this shorter term DTE, is because they want to realize the profit fast, right? Because if 0 DTE just means that at the end of the day, you are able to realize a profit or a loss, right? They want a quick reinforcements of, whether you're going to be making money or losing money. Now, why do I say that we want to go for the 45 DTE mark instead of those, at a very shorter term DTE? Well, the main reason we want to go for roughly around the 45 DTE mark is because of this statistical edge. So the main reason why we want to stick to around the 45 DTE mark is because this is the only time where the expected move is bigger than the realized move. So our edge when we are trading Iron Condors come in the fact that the realized move would be smaller than the expected move. Right, so as you can see down here, if we go for the 45 days DTE, you can see that the expected move is bigger than the realized move, which means to say the realized move, the actual move in the market, is smaller than the theoretical range by the mathematical model by which they price options. That is why we want to go for the DTE, whereby the realized move is actually lesser than the expected move. But if you were to take a look at the days that is lesser than 45 DTE, you notice that the expected move is actually not bigger than the realized move. All right, as you can see, no, 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 and no. So it's all no for anything under 45 days, right? You can see the expected move, which is basically the expected range for the 7-day one, is roughly 2.1%. Right, but the realized move is 2.2%, which means to say it's actually moving bigger than the realized move. So when we place our strikes, we want to place our strikes roughly around the expected move range, right? So let's say, for example, this is the expected range down here. So what we want to do is we will want to place our strikes somewhere around here, right? So you will place your short strikes here. So this will be where your Iron Condor call spread is, and this is where your Iron Condor put spread is. Right, so we want to put it around where the expected range is. But this is telling us that, at 7 days, the realized move is actually bigger than the expected move, which means to say that when the market actually moves, it could move past where our range are, right? Is where we place our short strikes at, which means to say we are not going to make money on the Iron Condor. We want to choose the DTE, whereby the range actually stays inside of this move down here, right? Inside of where we chose our Iron Condor strikes. And this can only happen if we choose the DTE, whereby the realized move is lesser than the expected move, which is why we want to choose 45 DTE. Now, step number 4. Once you've already identified the DTE that you want to choose to trade the Iron Condor on, the next step is to identify your short leg strike price around the expected move based on delta. So as a general rule of thumb, is the lower the delta that you choose for your short strikes for your Iron Condor, right, the more conservative it is, because you will have a larger profit zone, and the higher delta it is, slightly more aggressive, but of course you get more premium as well. So it is just a trade-off. There is no one that is better than the other. It comes down to, which one you feel more comfortable with. So as you can see on the left hand side down here, this is the option chain, but as you can see, it's pretty small. So let me just increase the size down here so you can see it a little bit more clearly. So when you open up the option chain, you'll notice that, you have the calls on the left hand side and you have the puts on the right hand side. So this is where you want to start to construct your Iron Condor. So the first thing we want to do is to select our short strikes, right? That means we want to choose the short put strike and the short call strike. So how do you want to go about doing that? And that is by choosing the delta that is around the expected move, right? So that will be the range of roughly 16 to 20 delta. So this is where we would want to place our Iron Condor short strikes at. Now you might be wondering, why is it roughly 16 to 20 delta? Well, the answer is because this is where the expected move is roughly around, right? So as you can see, this is another study done by the Tasty Trade team. You can see over here, it says one side, it says based on expected move formula. The other side, it says based on 16 delta options. So the one that is based on expected move formula, it will show on your option chain on the top right hand side, by the way, right? I don't show it here mainly because, right, if I was to show that, the picture will become too big, everything else will become, you know, very small, hard to see, but it will be shown on the option chain at the right hand side, right? It will show a plus, minus, and some sort of number at the right hand side. So let's say maybe plus minus 10. So it's telling you that the range is plus minus 10 from where the current price is, right? So let's say, for example, if the current price, as an example, is 170, then the expected range would be from 180 to 160, right? So this is how you do it based on the expected move formula, if you construct your Iron Condor based on that. Now, the other way and a simpler approach would be just using the 16 delta options, right? So all you have to do is just take a look at the delta column on your option chain, and you just look for the 16 delta options, right? So as you can see down here, this is the 16 delta. So we want anything from 16 to 20 deltas, thereabouts. We don't want too small of a delta, because if the delta becomes too small, you won't get that much premium and your risk gets a little bit higher, right? So generally 16 to 20 delta would be good. And the reason why we also want to choose the expected move, again, it ties back to the fact that Iron Condors will profit over the long term because of the statistical edge that the realized move is going to be lesser than the expected move. And again, it has to be roughly around the 45 DTE mark. So from here, as you can see, the theoretical win rate, as depicted by this word down here, you see expected occurrences within range. What it's trying to tell us is that if you choose based on the 16 delta options, it will be roughly a theoretical win rate of 68%, right? So this is the expected move, expected range win rate. Now, as we already know, if you choose the right DTE, the realized move is actually smaller than expected move, which means to say your win rate will actually be higher in actual trading, right? So as you can see down here, this shows you what is the actual occurrences. So as you can see down here, it says actual occurrences within this expected move. So if you were to see based on expected move formula, it says 85%, and based on 16 delta is 71%. So both of them, as you can see, is higher than the theoretical win rate, and that is why we actually have an edge over the long term. Now, one thing I just want to point out is that this number, 71% and 85%, should actually be swapped. And the reason is because the expected move formula depicted by the number on the top right hand side of your option chain is actually a smaller range than the 16 delta options, right? Most of the time, if you were to go to your option chain and then you were to just, compare both of the ranges, right? If you were to compare the range of the expected move based on this number down here, maybe the range will be somewhere like this, right? So from here to here, this will be the range. And if you were to compare it with the 16 delta options, you will see that the 16 delta options most of the time is actually much bigger than the expected range calculation based on this number. So that is why this number should actually be swapped, right? So that is why the 16 delta options actually give you a higher win rate than you actually theoretically should be having. Next, step number 5, once you have already identified your short leg strike prices, the next one to do is to identify your wings, right? Where you're going to buy the put and the call to have these wings for your Iron Condor. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So the way you want to do it is based on the risk that you actually plan to risk for the trade. So let's say, for example, your risk per trade is $500, right? That means to say you want to construct an Iron Condor where the most you can lose is $500. You don't want anything that exceeds that. So the first step you want to do to create your Iron Condor wings would be to just go with the width that corresponds to your max risk. So as you can see down here, your max risk is $500. So you just go with a $5 width on both sides, right? You construct a $5 width on your call spread side and a $5 width on your put side. This is a way to just get started, just to put your Iron Condor strikes on the option chain, and then from there we will adjust, right? So let's say, for example, you put on this Iron Condor with a $5 white. So by the way, you have already chosen the delta. Let's say maybe you have chosen the 18 delta for the short call and also the 18 delta for the short put side. So we've already got these short strikes figured out. The next is our long wings, right? The wings will be the +1 call and the +1 put. So we want it to be $5 away from where the short strikes are. So let's say, for example, if the short strike on the call side, let's say is $180. So this is where you want to take $5, add on to this. So your wings will be 185. And let's say on the bottom side, let's say, for example, it's $160 for your short put strike. Then you want to take $5 away. So this will be at 155. So this is how you construct your initial Iron Condor trade. So once you have constructed this, you should be able to get the premium. So let's say, for example, the premium is $1.25. That means you're going to receive $125 for every one contract of the Iron Condor that you put on. Now, how do you calculate what is the max risk? So generally on the platform, it should already tell you what is the max risk, right? But if you want to know exactly how it's calculated, it's actually pretty simple, right? First of all, you just take the maximum width of the wings. So as you can see down here, it's $5. So you just take $5 minus off the premium and you get $3.75. So this is your maximum loss that you can lose on this trade. So again, based on one contract of the Iron Condor, it's $375 per contract. So at this point of time, you've already constructed your Iron Condor, and you notice that, you still have some room to increase the risk of your trade, right? Because the max risk you have already decided is $500, but this construct gives you a max risk of $375. So you want to try and increase this. So at the same time, you can also get slightly more premium. So how do you actually increase this risk down here? So the way you want to do it is just by simply adjusting your long strike prices, right? So previously you were at $5, so you want to just increase it by another dollar or another strike price, and you just see, right, from here, what is the kind of maximum risk here. So let's say, for example, you've increased to $6 wide on both sides. Again, it's very important that for you as a beginner to trading Iron Condors, you want to trade Iron Condors with even wings on both sides first. Once you get a little bit more experience, then you can go for a skewed Iron Condor, whereby, one side might be bigger than the other. But at the start, just keep them the same, right? So let's say we keep it to $6 width on both sides. So this is where you start to calculate what is the max risk again, right? So again, you should see that your premium would have increased. So in this case, it has increased to $1.50. So this is how you calculate your max risk on the trade again. You take the width of the wings. So as you can see, $6 minus $1.50. It becomes $4.50, which is $450 per contract. So as you can see down here, you pretty much hit, very close to 500. And I would say this is more than good enough for you to put on this trade. Now, step number 6, once you have already gotten this Iron Condor structure out, this is where you want to start to send this order in and get executed on this trade. So the way you want to do it is by placing a limit order, right? You always want to place a limit order on your Iron Condor so that you can control the price at which you get in, right? You can control the premium which you get. So as you can see over here, this is the Tasty Trade platform. The Tasty Trade platform will show you what is the credit that you want to get that you place for the Iron Condor. So let's say, for example, it's at $1.38. Now you notice below there is this range down here. On the left hand side, it says net, NAT, which is the natural. What it means is that this is the natural price that you will immediately get filled at if you put it at that price, right? As you can see, it's $1.32. And in the middle, it says mid. So this is the median price at $1.36. And on the right hand side, it gives you, the other end of the price, which is at $1.41. So generally, when we put on the limit order, we want to try and get as good of a price as we can, as good as a feel as we can. Because first of all, we already know for sure we can get filled at $1.32. But we might want to get slightly more credit, right? Because every cent equals to $1 in premium that you receive. So if you see that the mid is $1.36, what I generally like to do is just to increase it by a couple of cents, right, to the right hand side to just get slightly more premium than what the middle price is indicating. So in this case, I will just put $1.38 in and then just see, whether I can get filled. Right, sometimes you could get filled, sometimes you won't get filled. Also, don't forget that the market is always moving up and down. So as the market is moving, this median price will keep changing as well, right? So it might actually move the median price might actually move up to become 138 and you could get filled then. Or on the other hand, it could move down as well. So it keeps moving, it keeps changing. This is one thing you have to keep in mind. So let's say, for example, you put in at $1.38 and you notice that you're not filled. And you do want to get filled, right? So your prerogative is that you want to get filled on the trade rather than just get, you know, the kind of premium that you're just waiting for, and you're willing to let go of the trade if you don't get the premium, right? That's another way you can do it. But let's say you want to get filled, then this is where you want to inch down your price, your limit order, slowly downwards until you're able to find the fill price, right? So basically, this is what you call price discovery, where you just adjust your limit price order a bit by a bit each time to see whether you get filled. So for example, what I'll do is I'll put it at $1.38 and I'll just wait for a few seconds, right? Maybe 30 seconds or something like that. And if I do not get filled, what I'll do is I'll adjust it again, right? I'll adjust it down now to $1.36 and see whether I get filled. Now, let's say, for example, at $1.36, I don't get filled and I really do want to get filled. Then I will adjust it again. I will move it down, $1.34. So at this time, you notice that the mid price has shifted down, right? The mid price has shifted down from $1.36 to $1.35, which means to say it becomes a little bit harder for me to get filled at the price which I want. So again, I will try and adjust it until finally I get filled. All right, so this is the way that you want to do it as well. You want to use the price discovery method at the start, where you inch it down rather than you immediately get the natural price, because the natural price most of the time would be the worst price that you can get. Now, finally, step 7. Now, step 7, this is where you want to plan your exit scenarios. And in my opinion, this is the most important step, because you need to know what to do once you've already got your trade in, right? Many times you'll be surprised that I get people emailing me, showing me their positions, and most of the time these positions are losing a lot of money, right? They are deep in the money and they're going to ask me, you know, Davis, how can I salvage this position? So my take is that if you can put yourself in a position where you have to ask me, then you shouldn't be in the trade in the first place, because you should already know upfront beforehand when you're going to get out of the trade, right? So I'm going to give you a few different ways that you can get out of the trade. So the way you want to exit the trade would either, first of all, be based on a fixed take profit price. So let's say, for example, 50% winner. So as you can see down here, this is done by the Tasty Trade team, where they compared 3 different exit points, right? You can exit at expiration, exit at 50% winner, and exit at 21 DTE. So 21 DTE just means there's 21 days left to expiration, not 21 days in a trade, right? Just to make it clear. So for example, if you put on the trade at 51 DTE, you have to wait 30 days before it becomes 21 DTE. Okay, so based on this table down here, as you can see, exiting at 50% winner and exiting when it's at 21 DTE will have a better performance than if you were to exit at expiration. So you want to choose either one of these two or a combination of both of them. So the 50% winner has a higher win rate, mainly because whenever it reaches 50%, you quickly take the profit off, right? And that can happen quite often. Whereas on 21 DTE, you have a slightly lower win rate, because even though it has already reached 50% take profit, you might still just hold on to the trade, and that trade could possibly still turn out to be a loser when you could have taken off at 50% take profit. But at the end of the day, you notice what's important is this daily P&L, right? Which means to say this is the average P&L that you get on a daily basis. And you can see based on 21 DTE, you actually get a higher P&L. And the reason is because at 21 DTE, you could actually make maybe 80% of the premium that you receive, or maybe 90% of the premium received, right? So you average it all out, you tend to get a slightly higher P&L than the 50% winner. So which is better? I would say that there is not one that is better, because both have the pros and cons. So as you can see down here, based on 50% winner, the pros is that you have a high win rate, which means to say you're going to experience more winners. So if you're the kind of person that likes to keep winning, then you might choose for the 50% winner, take profit. And the cons is that you have no loss control. So no loss control means that if you do not hit the 50% winner, you might just leave it all the way to expiration, which could be the max loss. Now, whereas for 21 DTE, the pros is that you have a lower volatility, because when you cut off the trade at 21 DTE, you very, very rarely, very, very seldom actually hit the max loss on the trade, right? In fact, most of the time you won't hit the max loss because you're cutting it off well before it reaches that point, right? The cons is that the P&L is pretty random, because you won't know where the P&L is going to be at 21 DTE. So the other alternative would be to do a combo, right? The combo, which means to say you do both the 50% take profit or the 21 DTE, whichever comes first, right? So if it doesn't get to the 50% take profit point before 21 DTE, at 21 DTE, you want to just exit the trade, right? Even though it's a loss. So one thing to really understand about trading Iron Condors is that this is not one of those 99% or 100% win rate where everybody is talking about, right? Iron Condor, you will win most of the time, but there are still times you're going to lose. So this is very important to understand. So as you can see down here, this is again another study done by the Tasty Trade team. And you can see down here, this is based on the 20 Delta $10 white Iron Condor. So the way they conducted this study is by simply putting it on, and whenever it reached expiration, they put on another one. And for the 21 DTE, whenever it reaches 21 DTE, they close it and then they put it on again. So for both of these two trades, right, the exit at expiration, exit at 21 DTE, both are actually profitable over the long term. As you can see, the study is somewhere from 2007 all the way to maybe past 2017, maybe 2018. But the thing is that you can see that 21 DTE has the much more superior performance, because from 2011 onwards, all the way to, you know, wherever the study stopped, somewhere around 2018, you can see that if you hold all the way to expiration, you actually have, you know, a pretty bad performance. Whereas the one at 21 DTE, you still keep profiting and the graph just keeps going up, right? So either 21 DTE or 50% take profit, or a combination of both would be good here. So one thing I want you to look at is also that you notice that this graph, there are times where it comes down, right? Over here. So these are points where there will be strings of losses, and this is where you're going to get, you know, losing trades. As again, I told you before in many of my other videos that Iron Condor, if you place it on the expected move range, is roughly around 65% win rate, right? Which means to say there's also a chance that 35% of the time you're going to lose it. So you do not want to force it whereby every single trade is going to win. You just want to play it out. So as you can see, based on these studies, they made it very objective. They just let the statistic play out, right? Put it on the trade based on the mechanics. At 21 DTE, they exit it, and they just keep doing this, repeat and rinsing this over time. And as you can see, as long as you keep doing this, even though they are losers, over the long term, you can still be profitable. Alright guys, so this is the 7-step Iron Condor trading plan, and if you like this video, I'd greatly appreciate it if you give me a thumbs up. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.